Good evening, everybody, and welcome to the May edition of Making Sense of the Markets with Chris Kerlow and Team LWC. My name is Mitchell Shields. I'm the financial planner with Team LWC, and just want to get things teed up for our session today. Chris titled the session today, Rebel Without a Pause. So there's going to be a few key areas that we're going to discuss as we go through this webinar today. Some of the main topics Chris is going to look at discussing is the Fed rate hike decision, forward guidance and outlook for the markets. We're going to talk about if the bottom is in for earnings or if there's going to be more pain to come. Talk about some opportunities abroad and more generally talk about some recent portfolio positioning within our clients' portfolios. Throughout the session, I'm going to be watching the question and answer box. So if anybody has any questions for Chris on the portfolio, outlook for the markets, or what have you, great time to get those questions answered live. So throw those in the chat box through the session, and we'll save some time at the end to answer all of your questions. So without further ado, I'll pass things over to Chris to get today's presentation started.
Thanks, Mitchell, and thank you, everybody, for joining us today. I went with the Rebel Without a Pause title today after the popular single from Public Enemy in 1988, following Jerome Powell's balancing act after raising interest rates yet again 25 basis points while trying to stick handle his opportunity to say that that should be it, but leaving the door open just in case. For those of you that don't know the Public Enemy song, it came from a reference of the 1955 film Rebel Without a Cause, popular actor James Dean. So that's where that came from. Quick stop on the disclaimer. And here we are right into it. So like I mentioned at the top of the introduction, we saw another rate hike from the Fed, putting the overnight lending rate at 5 to 5.25%. That's quite a substantial move in the last 14 months, the fastest in history. And surprisingly or not, the market is now pricing in that this is the top and about a 90% chance of a hike before the end of the year. Sorry, a cut. Why would the Fed pivot in that strategy? It's because we go into a period of economic weakness. We're probably going into the most highly anticipated recession of all time. I'm sure a lot of you around the water cooler are talking about this with friends and family. And I think that's an important point to note, that the markets are a forward leading indicator. We'll talk about some of the opportunities we're looking at opportunities that are actually going to do well post-recession. So as institutional portfolio managers here at Team LWC, we retain a disciplined process and are looking past kind of what everyone's already anticipating. You can see that interest rate moving lower on the top right chart there. The recent weakness in regional banks and the banking sector in general probably added another full percentage point to this rate hiking regime from the terms of impact. It's also important, and the Fed needs to balance this, that most rate hikes take 12 to 18 months to take full effect. So it's probably a prudent decision to take their foot at the gas. They did remove the quote from their report that the committee anticipates that some additional policy firming may be appropriate. And then I watched kind of the press conference thereafter, and it really was a balancing act, suggesting without saying that they'll pause while retaining that they'll be data dependent should inflation come in a little stronger than expected. With that, the daily topic out of the way, let's look into what's been happening here during earnings season. It's been a tremendous start to the year for assets, particularly risk assets in the tech sector. We've seen the NASDAQ advance over 17% year to date. The S&P 500 is up 9.2%, and the TSX up 7.6%. Of that S&P 500 gain, about 2/3 has been concentrated in the big tech names. Why is this happening? Again, those are forward-looking assets, long duration assets, meaning a lot of their earnings, you think about Tesla, what they're doing, even Microsoft and Alphabet, the iPhone's priced in, it's about what they're going to earn in the future. Those need to be discounted back. When they're discounted back at a higher rate, that's going to tend to cause the stock prices to go lower, like we saw in 2022. Now with the market foreseeing that rate hike regime over and possibly a rate cutting regime coming into play, those assets have led us higher, making it a challenging environment for stock pickers when all the gains are concentrated in such few names. Fortuitously, the LWC US Growth mandate owns NVIDIA. With our disciplined approach, we have trimmed it several times since our purchase in October. When it was in the 90s, it's now in the high 200s. And that is just an example of how we're constantly pivoting our portfolios as things are moving and changing in the markets. There has been a long-term forecasting by participants that we'd see earnings retracing. You see that we have experienced that over the last several quarters with the chart on the bottom right. But this most recent quarter actually saw a gain on a year-over-year basis and a quarter, not quite a quarter-over-quarter, but you can see that. And revenue, however, has seen a gain on a year-over-year basis. And the expectations are that both earnings and revenue advance as we look out into the future. That's encouraging because listening and reading some of these transcripts, it has been very bearish. We think that the expectations from our companies that we own are too pessimistic, and that there's a good chance that, you know, Q3, Q4, that they outperform those expectations, pivoting us to think that there's probably more risk to not be in the market than there is to be in the market, despite us believing that we actually will see some economic weakness and slowing down. Going to that, slowing earnings like we've seen over these past couple of quarters tends to be followed by slowing consumption. We kind of need that slowing consumption for Jerome Powell and the Bank of Canada to remain on the sidelines. The labor market remains hot. However, we have the non-farm payrolls number coming out on Friday in the United States. It's expected that we'll see about 175 job creations this month. That'll cause the 6-month rolling average to start moving lower. Lending standards in the United States, as you can see from the chart on the top left, are now close to the pandemic and 2008 challenging times. That's from like the tightness standpoint, posing, you know, a lack of easy credit, which should help slow things down, as, you know, getting access to credit commercially or personally only helps support growth. So we see that pulling back. The profitability decline that we saw first in technology and financials is now starting to roll into industrials. And this less consumption will likely lead to less job creation. And so that should help the Fed stay on the sidelines for a little bit here and let us kind of move forward. That does roll into how we are positioning our portfolios. We continue to move assets overseas. We added a little bit to Europe with some exposure to emerging markets, regions like China, which is, you know, just starting to reopen. It saw 9% annualized GDP growth in the first quarter of 2023. And the euro, JGB, and yen all still look attractive to us. That's kind of where we start when we're looking at overseas opportunities. You need to consider the currency's impact on your translated returns back to Canada. You know, if an asset goes up 10% in Europe, but the euro declines 10%, you're out of wash. We have opportunistic outlooks for the yen, the pound, and the euro, largely because of where they are at on their monetary cycle standpoint. Canada and the United States are now at a standstill. They're continuing to ease, raising rates. The Bank of Japan is doing several different things that are making it easier there from a monetary standpoint. And then European assets look cheap. That's what we're showing here on the chart on the top right. That's a relative valuation from the United States to the European indices, albeit strong returns off the bottom, like most indexes. We see that happening there. We're also looking for specific opportunities in the Chinese service sector and things related to travel, as we see a similar type of reopening in China as we saw in North America. That leads us to our next trade, which was adding exposure to Japan. Japan's actually a great play on a global recovery. Like I said at the onset, you need to kind of get into things before everyone realizes it. We're looking through the chasm here and expecting an opportunity to come about. Japan and the yen have already started to move higher. You can see that in the chart on the bottom right, albeit with tourism, which we're showing on the chart on the top right, still below 2019 levels and just getting started on where Chinese tourism was in 2009, just 10% of the level that we saw there. Still very cheap valuations in China. It's been written off many times. Market pundits talk about the lost decade of kind of flat equity returns over a decade. We're taking a bit of a less consensus view and think that there is an opportunity there. And again, a bit late to the party on coming out of COVID. So some of that economic reacceleration as the economy gets going. And lastly, you know, industrial mature nation that's very shareholder friendly. Buybacks and dividends continue to grow strong. And the Bank of Japan is finally, after a long time, looking like they'll be lifting their yield curve control policies, which should support the yen and bring back stronger translated returns here to Canada. So with that, I'll take a pause and see if any questions came in before I roll into a couple that we had sent in previous to the call.
Awesome. Thanks, Chris. So it looks like right now, looking at the live chat, I didn't see any questions come in during the presentation. If anybody's got any questions, fire those in there. I'm going to be watching the chat and I'll bring them up to Chris. But Chris, if you want to field a couple questions that came in with the registration, this is a great time.
Great. So the one we had was regarding the regional banks. We saw First Republic taking an FDIC receivership earlier this week. It was then bought by JP Morgan, taking over the full package. There was rumors of who would buy it. It really was only JP that came to the table. This after just a few weeks when their CEO, Jamie Dimon, said they had no interest in Silicon Valley Bank. A bit of a different story. They had about 90% of their deposits uninsured. And all the other buyers that came to the table didn't really want the full package. So JP Morgan picked it up. We also, that caused the regional banks to come back another 3% on the day, down 24% year to date. Even more so if you look back to the end of last year. On our last conversation, we talked about our addition to actually the money center banks, the bigger banks. We see less contagion risk or fears there. If we did see further weakness on the regional side, we believe that the Fed has shown a precedent that they're going to kind of not let these things fail. To be honest, there's probably some moral hazard risk in how far they've gone in showing other bankers that you can't really get in trouble if you do non-stringent lending standards, that they'll be there for last resort on people's deposits. But with that said, we see more opportunity than risk in this part of the market. That leads into, in a way, our second question was concerns about the commercial real estate sector. A lot of people, if you're reading financial literature, saying that this could be the next shoe to drop. Question was, is there a crisis coming here? The sector is a casualty of what we've seen in the regional banking sector. About 2/3 of commercial lending in the United States comes from regional banks. They've really tightened the bootstraps. So, that's been more challenging for commercial real estate to get access to capital. You add to that higher rates, makes a lot of these projects unfeasible. And so it's been a challenging time for the commercial real estate sector. You look at office REITs, they've taken the brunt of the pain as demand has gone largely away and you have this supply demand imbalance. I'm joining you remotely. I know a lot of you are watching from home. Previous to this, I'd be traveling the country doing these in offices around our great nation. And, that's just simply changed through, everybody being able to access these things online and change this medium across many platforms. It's much more accessible. So that dynamic has changed. Another interesting fact that not a lot of people might be thinking about is climate change. A lot of buildings are pursuing LEED certification here in Canada, in Europe, and the United Kingdom. They have stringent legislation that's kicking in 2030 that companies are going to need to retrofit current buildings, and doing a cost analysis. A lot of them are just going to become obsolete. With crisis comes opportunity. I was just in Arizona doing some due diligence on a self-storage investment that we've participated in years past. A big part of their asset net value add is buying some industrial, commercial, office buildings and refurbishing them and turning them into self-storage. It's a really quick return on investment, high IRRs, population density in areas like the United Kingdom, Toronto, Scottsdale, and death, divorce, and displacement. There's always kind of a movement of people where storage is a necessity. So really interesting space there. Later this summer, Matt and I are going to be traveling around the United States looking at some commercial office retail. Even though everything at some point has a price to buy it. If you're willing to give me an office tower for $1, I'm interested. We need to kind of see a bit more pain there. So, is it a crisis? We'll see, but we would expect some more challenges in the sector. We're avoiding it and, but have our eyes open and doing our work now so that when the opportunity comes available, we've done the due diligence to be confident to move into opportunities that present themselves. And with that, I'll pass it back to Mitchell. If there's no other questions, sign us off, Mitch, and we'll wrap it up there.
Yeah, sounds great, Chris. No, thanks for that. And thanks for those questions. It led to some great additional content. So that was great that we got those questions in beforehand. No questions in the live chat. I'll keep watching it. So if anything comes in last minute, I'll absolutely cut myself off. But again, thank you for attending this month's session, this month's webinar. We're going to continue to do this on a monthly basis on the first Wednesday of every month, 4 to 4:30, just kind of dependent on some potential circumstances. But appreciate your attendance. Within the next little bit, we're going to send out a recap as well. So everybody will get an email recap of the video. So you've got a copy of it. Feel free to share it with anybody who you think would find it valuable. And like always, thank you again for your trust in working with Team LWC. And if any questions come up afterwards, shoot them to a member of the team, and we'll make sure we get them answered for you. Everybody have a great night, and we'll talk again.
One last thing I'll just throw in there, Mitchell, that came to mind is supplementing our monthly Making Sense of the Markets. We've now started a manager oversight series. Yes. Where we are doing an interview with all the portfolio managers that run our third-party products. Those can be found on our YouTube channel. We'll also try to find a time to email those out to you to help give you confidence in the solutions that we're using to help manage your wealth. As we're experts in certain areas, we do think it's worthwhile hiring experts in their own individual expertise to add that diversification. And we're doing these to help educate you, give you more confidence and comfort in understanding the solutions you provide. So I'm happy to direct you to the YouTube channel and watch out for those. We just did a great one with Wavefront's portfolio manager, Roland Ostrup. We have another one coming up this month with EdgePoint. So please tune into those as well. Thanks, everybody.
The one with Roland actually just went live today. So that's a great point, Chris. Thank you. So yeah, again, have a great night, everybody. And yeah, take care.